I'm Dr. B, and yes, I'm a real ER doctor, so you may be wondering, what am I doing here in this space? Well, after years of pain from sports injuries, I listened to my doctor and had to pivot into a career that would keep me off my feet as much as possible. I also have a degree in finance, and so it was a natural transition to join Verified Investing. I'll share my prescription for becoming a successful investor right here on the Market Pulse. Welcome to the Market Pulse. I'm Dr. B at Verified Investing. Today we have a special episode with a special guest to talk about all of the volatility in the markets. We'll be talking about bond volatility, the volatility in the VIX, and just so many other really interesting things. So stay tuned. So I'd like to welcome our guest, Ryan Dykmans, Chief Investment Officer at Dunham & Associates Investment Counsel. Ryan, thanks for coming on the show today, and thrilled to have you. So, the first question I wanted to ask you is, you mentioned there's some stubborn inflation going on right now. Can you speak to that a bit?
Absolutely. So obviously the inflation reading has been closely watched. The markets are excited to see, obviously, inflation come down so the Fed can actually begin to cut rates. Unfortunately, it's been stubborn. The reading actually came in just a little bit higher, not much, but it was enough to make markets concerned that the Fed could delay their rate cuts. And that delay in rate cuts is hurting both equities, it's hurting both, fixed income as well. And so what we're really seeing on our side is a little bit of volatility spikes that we haven't seen in a while come back up a bit, especially on the equity side.
Sure, and if you can see my chart here, this is the Fed funds rate on the monthly chart. Obviously, here's the spike here in the 70s and 80s. What I noticed is the Fed funds rate is right here, essentially at the same area that it was right before the 2008, 2009 Great Recession. So that's a pretty interesting correlation there. What are your thoughts on that? Do you think that these rates are putting more pressure on the economy? Jerome Powell talked about potentially cutting rates in 2024. Now there's some talk about maybe only 2 rate cuts instead of the 3 rate cuts that the market was predicting. So what are your thoughts on that? Do you think we'll see a rate cut in 2024?
I do. I do think we're going to see 1, maybe 2. I was saying 3 literally a month ago, but what happened with the stubborn inflation, it really has made it so it's a little bit more of an uncertainty if we're even going to get the 2. I would have said 2 for sure, and maybe 3, and now it's 2 is maybe the hope. Now, in regard to your rates that you see there, kind of going to 08, 09, obviously we all cringe when we think about that time period. I remember, the volatility was through the roof, especially through mid-08. But one of the things to remember, too, is that Bernanke came in, so Chair Bernanke, and he introduced something, that we hadn't really seen used heavily, which was that quantitative easing. So the Fed balance sheet is going to be much, much more important in addition to those rate cuts. So I think you kind of have a few more tools in the toolbox that Chair Powell is willing to utilize. I guess another way of saying that the rate cut itself, yes, important, yes, helpful to the markets, is a great signal that things are getting better for the, again, that tailwind that rate cuts provide. But the quantitative easing aspect of it will also be important, how they basically build up or unravel the balance sheet to control the yield curve.
Yeah, that's so interesting, right? Because during this time, after the Great Recession, they had this quantitative easing, pumped a bunch of liquidity into the markets. And then obviously after all of the stimulus during COVID, there was this quantitative tightening, right, that was going on for quite a while. And it seems like that kind of ended in a way with the banking crisis last March. And so we saw that emergency funding program start up, which essentially pumped a lot of liquidity into the market. Can you talk a little bit about that and how that may have buoyed markets over the past year or two?
Yes, definitely. So something that the Fed has done a lot better, I'll say, in the last 20 years, is they're signaling to the markets what they're going to do and how they're going to support the markets. So we saw this Fed come very quickly to say, hey, we're backstopping the banks. We're, as much as possible. We're going to come in. We're not going to let there be a run. And that liquidity support that they provided was very quick. And again, they gave some relief on the type of assets they have and how to mark them down, which obviously is part of their stress testing and all that too. They easing that made banks a little bit, I'll say, feel a little better, look a little better. And to investors, they stopped having to be so concerned that there's going to be this big run.
Mm.
But on top of that, with the Fed coming out and saying, hey, we are looking to cut rates still. They're reminding us they're going to cut it this year. That should also, over time, help the banks too with a non-inverted yield curve. It's weird to have an inverted yield curve this long, and actually, this severe. So that's been a strain on the banks. And I think those two things coupled together will help a bit with bank liquidity and obviously positive assets on the bank balance sheet.
Sure. Yeah, and talking about some of the banks and having some of the unrealized losses in their bond portfolios. This is the MOVE index, right? So it's the bond market option volatility estimate index, and I think you're more familiar with this than I am. Can you talk a little bit about this and how this may have been affected by that banking crisis? This looks like maybe this was the time when the banking crisis occurred.
Yes, sure. So think of this as kind of like the fear gauge for bonds as opposed to for equities. You have the VIX, which is the fear gauge for equities. The move is going to be that for bonds. And this is really the option volatility on those different, we'll say different, length treasuries. So you're going to see as there's more and more uncertainty about rate movements, this index kind of goes a little more wild. So that could also be just that there's a delay or longer pause in those rates. And when you see this higher level that we've seen for a little while now in the bonds, it means that what you're seeing in the bonds is a higher priced in volatility, meaning that people are a little more concerned about rates here and how it's going to be affected. Whereas if you kind of were to overlay that in some way with the VIX, you'd see the VIX has been really low until just the last week,
Yeah.
where we saw a little bit of a pickup. So
Yeah.
again, the move being higher like this just means that there's been more uncertainty for a longer period of time. Kind of think of it mainly from like 22 into 23, like you said, when the SVB issues occurred or came to surface. So we view this as a kind of the market already has priced in the issues for bonds, and maybe hadn't done so for equities.
Interesting. So you're saying that this is probably the average, and this goes back to let's say 2018. This chart, but I can go back even further. It seems like the average is around, I don't know, somewhere around 80 on the chart here. But you're saying with the bond volatility index being up in this area, that tells us that there's heightened volatility, and so that's stayed high, very high for quite a long time here.
That's right. And this is generally like smarter money. That's the way to kind of think of it. This is not a bunch of retail investor flows that cause this. It's going to be generally from your bigger banks and institutional flows that causes kind of volatility to be priced into these options. So, it's not your everyday retail investor that's buying and selling these things that shows this kind of stuff being priced in. It's going to be
Interesting.
your big institutions.
And so this looks like COVID right here. So the bond volatility spiked, and so that would tell you that. So this essentially moves inverse to the S&P, I would imagine, or equities, right? So as this spikes, the S&P goes down and equities go down, and the same thing when this goes down, the equities market starts to rally, right?
Think about it more with bonds. So it can be with equities, right? When there's that much fear that it jiggles bonds around enough that this is caused, it can coincide with equity spikes too in volatility. However, this is actually going to be very bond specific. So think of it, if the Fed said, hey, the economy is doing so well, we're very excited for it. If you're an equity investor, you should be thrilled, and earnings continue to come in nice and hot. You could actually have a series where the equity market continues to look, I'll say, fairly stable, upward sloping, but the bond market can get very wild and very crazy very quickly, which means that's when you see those spikes. So COVID is a great example. What we saw around that March 20th kind of time period of 2020 was you had this huge spike in volatility for both equities and bonds at the same time. I saw AAA bonds drop 17% in like
Wow.
a few days.
Wow.
So I was tracking those, kind of watching them, because we obviously try to take advantage of that kind of stuff. But when I was looking at that, I couldn't believe that you saw bonds drop as much, if not more in some cases, in certain equities.
Wow.
So anyways, you're right. In many cases, it does coincide with, especially the biggest spikes, with equity sell-offs. And it's just because people are so scared of what's going on. And they panic and they move very quickly in and out of things. And obviously those big institutional investors are trying to take advantage of that when they're adjusting their implied volatility they're willing to pay, which is basically what you're looking at in front of you.
Very interesting. Yeah, and you talked about the VIX. Let's go over and take a look at the VIX. So what are your thoughts here? So this chart goes back to, let's say, 2012. You can see this big spike here on the VIX. Oops, let me switch my screen here. There we go. You can see the VIX now.
Yes.
So yeah, about 2013, 2012, and you can see that the average area here on the VIX is, right around these levels, say 17, 15. Obviously, this is COVID. This is the COVID spike here. So what are your thoughts on the VIX currently and where we're at now, and with the S&P being so high? What are your thoughts on the VIX?
Sure. So I'm actually excited to see the VIX come up a little bit in value, get back towards that kind of 17 range. When it's below 14, what we've historically seen is that's a very calm, number to see it, right? That means that investors are not very scared. Markets are running hot usually at that same time period. So you have a large equity run up at the same time that those numbers stay low. So getting the little spikes, these little jolts that come through where it starts to go back to 16 or 17, which is just average, usually coincides with some good dispersion in asset classes. So within the equity markets, you'll see different sectors moving drastically different from each other, as opposed to when it's below 14, they tend to act more harmoniously. You get a lot more of the same movements together, and it's kind of more grouped and generally up. So I like to see these little jogs downward every once in a while. Nobody wants to see a negative equity market for long periods of time, but in short periods of time, it creates some really neat opportunities, especially if you have kind of an active allocation or you're willing to make moves at different levels. So I think, whether you're following a Fibonacci sequence or whether you're following some other kind of charting, you can take advantage of these different thresholds that get breached as volatility comes through.
Yeah.
That kind of narrow channeling that occurs, where it's very, we'll say less dramatic movements up and down, does not give you a lot of opportunity to make changes.
Sure. Yeah, it's a good point. And I don't typically use technical analysis so much on the VIX, but what I do see here is that you notice there's this trend line, right, that the VIX is essentially abutting, right up against. And I think if we break above that, right, you'll see most likely the S&P come down, equities come down. So definitely something I'm taking keeping an eye on as well. I also wanted to talk about money market funds. What are your thoughts on? I saw a couple articles where there was over $1 trillion, of flow into money market funds, and I guess I would ask you, what are your thoughts? Where does that money go? Does it stay in money market funds and get the 5%, 5.25% that they've been getting? Does it go into bonds? Does it go into equities at these levels? How do you? It seems like a lot of money on the sidelines.
It is. It's a ton of money on the sidelines, and really, what it comes down to is that money. A good chunk of it'll stay, right? There's a good amount that's kind of a balance. You kind of see people keep in money markets. They don't put all their money to work in risk assets. However, that money that's sitting in the money markets is like you said, it's benefiting from this higher short-term rate, and therefore, as yields come down on those short-term rates because the Fed starts to cut, once that occurs, it's going to start forcing people into that longer term and more risky type of assets. So whether it's treasuries that are longer term, or whether it's corporate bonds, mortgage-backed securities, or on the equity side, going back in the U.S. or foreign equity markets, all of that is dry powder for those kind of activities, right? That extra $1 trillion sitting there, even if just half of it moves, it's huge. And the other aspect is, right, I guess today, really, there's a lot of people who are going to be giving the government some money. And in election years, you kind of see the government tends to like to find ways to spend that money and give a little bit of a boost. So there may be even more dry powder moving in addition to those people who are going to start shifting out of money markets back into risk assets.
Interesting. Yeah, and I guess the question, here's the S&P 500, the SPY, right, the ETF for the S&P 500. And I would ask you, after this almost 30% run from October, November timeframe, do you see those money market funds going mostly into equities, or would you say that probably most of it's going to go into bonds, maybe a little bit into equities, say, potentially to buy the dip if we fall here further? So what are your thoughts there?
Sure. So investors tend to chase returns, right? That's kind of the old adage of it. And that's, again, the thing that kind of fails them at the end of the day, right? They chase returns up, and then after the sell-off, they sell at the bottom. Unfortunately, that's what a lot of them do. And so I do see a lot of the retail flows. So those retail money markets, if you were to kind of bifurcate the money that's in the money markets, I think a lot of that will try to chase returns. And so unfortunately, I think maybe going into hotter and hotter equity prices, but usually it's not enough to drive it that much higher. I would say, again, it's those bigger institutional flows, the bigger shifts, the bigger allocators, they're going to have more sway. So I think some of that money will move in. It's going to have a small impact, is my view. But then overall, I think I think that, bonds, especially longer term bonds, for those investors that are staying true to their risk tolerance, right? I want to be in more, fixed income and cash. If that's the way they're viewing it, I think you'll see it move into intermediate and long term bonds over time.
Interesting. So if you were to take and again, I'm not sure how much it is it 1.2 trillion, 1.3 trillion in money market funds? Do you know?
The last number I saw was just over a trillion.
Just over a
So
trillion.
I
Okay.
was looking at some ICI data. So ICI.org is the provider for that. And
Okay.
I was looking at some of the retail and institutional flows on money markets specifically.
And what percentage would you say is retail money market funds, and what percentage would you say is kind of the smarter money or the institutional or professional, money market funds?
Sure, I recall seeing it less in the retail side, but I'd have
Okay.
to double check for you.
So you're thinking with more so in the smart money side, they've kind of taken their profits potentially out of the market, put it into a safe money market fund, and then they're going to be moving potentially into bonds if the market, continues to pull back. Is that your thought, or not so much?
Yes, especially if the yield curve starts to positively slope more. So if you're continuing to look at this inverted yield curve, then no, because there's no benefit that the investor immediately sees of locking in a longer term, lower rate. What they want
Right.
to see is a longer term higher rate, giving a better reward for longer term money. And
Yeah.
so once that yield curve starts to steepen, I think that's really when you start to see people move out further on that yield curve. That's kind of when we go back to Bernanke, when he was doing Operation Twist and things like that, he's trying to change the shape of the yield curve to try to encourage flows at different spots. I think that's going to be the same thing here is that yield curve starts to slope up and you start to get some nice benefit for putting money away longer, locking it in at longer rates. I think you'll see more people move out that way. And so again, the rate cut from the Fed is going to be very important for these movements.
Interesting. Yeah, speaking about the bond markets, right? So we have the 10-year weekly chart here. It goes back to about 2010, 2012. Put it up here on the screen. You can see, actually, this goes to 2016. So what are your thoughts on the 10-year? We've seen a pretty big rise here in recent months. From around 3.75 up to now 4.65 area. What are your thoughts on what the 10-year might do?
Yeah, so this one's interesting to me because I know a lot of people who want to move into duration sensitive things very early on in this, right? They said, well, the Fed said they're done hiking. Let's load up on duration. So get that interest rate sensitivity through the roof. Let's start to get as much of that in our portfolios as possible. And the problem with that is they didn't anticipate having this higher volatility in bonds persist.
Hmm.
And so, that's something we've been concerned about. We did not jump into that area because it looked like there was going to be some more, I'll say, we didn't know there was going to be postponement like this on the Fed, but we did anticipate that there's going to be uncertainty about when exactly and how much exactly. And so that volatility has really whipsawed investors. And this rise that you just mentioned on the 10-year, that just shows you that there's so much uncertainty about it. There's so much concern about how that's going to move. Obviously, that also plays in a little bit to currency, right? So with the kind of the benchmark bond of the world being the 10-year US Treasury, there's a little bit of concern there about how that's going to affect foreign bond prices and foreign bond yields. So you kind of think about it like it's not just in our little microcosm we get in the United States. It's going to be beyond that too. So this is going to affect foreign bonds as well as they kind of look to benchmark to the US 10-year Treasury. And there's a lot of big ripple effects from that.
Very interesting. Very interesting. So let me just ask, terrible things happening over in the Middle East still. Obviously, some big attacks. Thankfully, there were very, very few people hurt or killed. Very sad. But I did see the oil markets spiking in essentially since the beginning of the year, really since the end of 2023. So this is oil right now, trading about $84 per barrel, crude oil. Let me just put the chart up there. What are your thoughts on the overall picture on the Middle East? Volatility for the markets, commodity prices such as oil, gold, silver, things like that. What are your thoughts?
Sure. So I think when you have these this can be one of those catalysts, right? When we look back and we look at a market environment, there could be a lot of reasons that we're kind of building into something happening. And then finally, when the other shoe drops and markets tumble, we always find that one or two things that we say, oh, that was the catalyst that caused it. This could be that. I'm not sure, right? We have to see how the market kind of reacts over the rest of this week. But ultimately, this is throwing another wrench into the works of what a calm market might be. We're already looking at people who are, like I said, they're concerned about rates, they're concerned about, equities in general. Just, what's the Fed going to do if they don't cut rates? Our equities going to have to price in basically a larger discount factor on that growth. And so all of that together, we believe is going to, already cause some headwinds. And then you get this. I was watching this over the weekend, kind of looking at futures and just trying to absorb what was happening, and seeing the spike up this morning looked like, oh, there was some good, positive, response. But now that it's been declining, the markets have kind of taken a little bit of a step back. There's a little bit of a concern for me in terms of where does this go next? Could this be another 1% to 2% drop like we saw last week, but now in reaction, obviously, to that turmoil in the Middle East?
Yeah, and I guess the question is, was the recent 2 to 3% pullback in the S&P because of the concerns in the Middle East, or was it because the markets are really just kind of overdone, they're overbought, and the RSIs, if you look at the charts, they're all over 70, and there's some divergence, right, bearish divergence on the S&P daily chart. There's divergence on the QQQ weekly chart, and you obviously have gold here, right? This is gold's chart on the daily. You can see that we've had a run from around 1800 end of 2023 up to almost 2500 in gold. And so the question is, you've got commodities prices spiking. You've got the 10-year inching up pretty rapidly over the past couple weeks and months. And you also have the S&P starting to pull back at the same time, when we have a potential war, a larger war breaking out in the Middle East. And so, yeah, I'm in the same camp where this might be that catalyst that causes just kind of tips the markets over and makes them fall. And so I guess the one thing I'll ask before I let you go, and really great discussion so far, is, here's the S&P 500. Where are your thoughts? If this is the catalyst, where do you think we pull back to? What's your target or potential prediction on where we pull back on the S&P?
Sure. So I could easily see a 10%, where we see a 10% correction, or even getting back into a bear market being possible in the short term. But there's a lot of, I do think it's run up with such a huge run up in the last, we'll say less than 6 months. There's a lot to get back. And
Sure.
so I do see that very possible. And you get this catalyst combined with a few more, I'll say, negatives on the rate front. And if earnings start to also slip a little bit, right? They've been looking pretty good so far. But if those start to slip a little bit, you could see a triple hit, which therefore could have double-digit declines. So looking at the S&P, there's a lot of things to be excited about, but there's also some precarious points that we're at now where I think it could really take a bit of a hit and a bit of a downturn. So 10%, 15%, I do think those are in the cards in the short run.
Honestly, that's exactly what I said back in mid-March, as I'm expecting a 10 to 15% pullback, so I think we're on the same page. I just pulled a Fibonacci level here, because I know you did watch my Fibonacci video on the Market Pulse a couple weeks ago, so thank you for that. And if you look at the 2022 lows to the current, the current all-time highs, let's just say that this is the high. The pullback would be somewhere around 440 on the S&P, which I think is around 10 to 15%. So yeah, interesting. It's going to be very interesting to see what happens. Hopefully the Middle East stays safe and peaceful. But hey, thanks for coming on, Ryan. Really appreciate having you, and yeah, we'll have to have you back.
Thank you, Dr. B. I appreciate it.
Thank you. Take care. So I hope you guys enjoyed that conversation with Ryan Dykmans. Really some interesting insight that he brings to the markets, and really a great conversation. So like and subscribe below. I'll see you next week, next Wednesday on the Market Pulse at 1 p.m. Take care.